Hi, my name is Jim and I was retired. In this week's video, I will cover the latest consumer price index numbers and the market's reaction to them. Wall Street definitely liked the December CPI print of 6.5% year over year. I think that's because, in part, Wall Street thinks the Fed will slow down and maybe even pivot soon. The question I have is the market fighting the Fed? December's consumer price index came in at 6.5%, down from the 7.1% in November. And the red line shows core CPI, which is the CPI minus food and energy. And that also came down from its previous month. It's now down to 5.7%, and it's in line with the trend that we've seen. If it continues that pace, the core CPI will be down to 4.8% by March. Now, core CPI is used as a proxy for the personal consumption expenditures, or PCE inflation, which is the Fed's preferred inflation measure. We won't get that number until the end of this month. But November's reading was 5.5%, and those dotted lines are the Cleveland Fed's nowcast of PCE for December and January. And you can see it's trending down, not as steep as the core CPI, interestingly, but it's trending down. So zooming into the next few months, though, the question will be, will we see a 25 basis point increase in February and March, or a 50 basis point increase in the Fed funds rate? If the Fed follows the path of quarter point hikes, shown in the orange line, they're only going to reach about 5% in March, which will be just barely over that 4.8 for the core CPI and probably where PCE is. If the Fed uses 50 basis point hikes, it will reach 5.5% in March, which will mean that the Fed funds rate will finally be above PCE, and therefore real policy rates will be in the restrictive range. Yet the market is convinced that the FOMC will slow to 25 basis point hikes in February. Nearly 94% of those investing in Fed funds futures believe so, according to the CME FedWatch tool. Only 6% think we will see a 50 basis point hike. And what's worse is that when you go to the probabilities page on the FedWatch tool, you'll see this table. And the blue indicates the arc of where they think the Fed funds rate is going to be. So they're looking for quarter point hikes in February and another quarter point hike in March, then a long pause through September, and then two declines in November and December. That's right, the market thinks there's going to be two declines in 2023, even though the FOMC has made it clear they do not see any cuts in 2023. Likewise, those two cuts would bring the Fed funds rate to where it is now, the current rate, which is clearly not restrictive. Now, if you go to the December summary of economic projections, you get the infamous dot plot. Now, each of these dots represents where a participant thinks appropriate monetary policy will be at the end of the year. And if you can see, there's only two participants who think the Fed funds rate will be just below 5% at the end of this year. Everyone else thinks the rate will be above 5% at the end of this year. So clearly there is a disconnect between the Fed and the market. I wonder if we will see a changing of those perspectives as we get to March, the next time they do that infamous dot plot. There either has to be clear communications from the Fed that says that we will be putting in rate cuts late in the year, or they need to say to the market, hold off. We're going to keep rates restrictive until we're sure inflation is returning to that 2% target. The 2%, by the way, is 2% PCE inflation. CPI inflation will probably be about 2.5% when they decide it's sufficiently in the target. By the way, please take a moment to like and subscribe to this channel if you like entertaining ideas. I'll conclude with my standard warning. I am not an economist and I'm not a financial planner. I'm just a DIY retiree. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next week.